This LOS is describe purposes of and controversies related to derivative markets. The purposes and benefits of derivatives. So in the text, there's 4 sections here with regards to the purposes and benefits of derivatives. For the slides, just giving the summary, you can go back and read the full paragraphs. The first one is risk allocation, transfer, and management. And the purpose and benefits of derivatives is that they allow the transfer of risk and management of risk, okay? The overall purpose of derivatives is to attain more effective risk management within companies and the entire economy. Although some argue that derivatives do not serve this purpose very well, for now you should understand that derivatives can improve the allocation of risk and facilitate more effective risk management for both companies and economies, okay? The second purpose and benefit of derivatives is information discovery. Derivatives provide price information, estimate the price of uncertainty and the volatility of asset returns, okay? The third is the operational advantages, high liquidity to derivatives, low transaction costs. Remember, that's not a purpose of derivatives, it's a characteristic that there are low transaction costs, and it's easier to go short, okay? Some markets it's not possible to short an instrument, but you can buy a put, for example. So if the price goes down, you can benefit from the price going down. And finally, the fourth category for the purposes and benefits of derivatives is market efficiency, the improved market efficiency of market prices, okay? Even if one does not accept the concept that financial markets are efficient, it is difficult to say that markets are not more efficient and competitive with derivatives. We'll just do a quick practice question. Which of the following characteristics is least likely to be a benefit associated with using derivatives? A, more effective management of risk. B, payoffs similar to those associated with the underlying. Or C, greater opportunities to go short compared with the spot market. Okay, this was looking for the least likely, so you're looking for the false, okay? So the way that I often do it is I say, what are the following characteristics is a benefit? Do it in the positive. More effective risk management? True. Greater opportunities to go short? True. Payoffs similar to those associated with, no, that's false. So that's the least likely. So B is correct because it's the false. One of the benefits of derivatives markets is that derivatives create trading strategies not otherwise possible in the underlying spot market, thus providing opportunities for more effective risk management than simply replicating the payoff of the underlying. A is incorrect because effective risk management is one of the primary purposes. We saw that in the previous slide. And C is also incorrect because one of the operational advantages associated with derivatives is that it's easier to go short compared to the underlying market, okay? Now we're moving on to criticisms and misuses of derivatives. And there's 2 sections in the reading. The first is speculation and gambling. Derivatives markets are unquestionably attractive to speculators. All the benefits of derivatives draw speculators in large numbers, and indeed they should. The more speculators that participate in the market, the cheaper it is for hedgers to lay off risk. These speculators take the form of hedge funds and other professional traders who willingly accept risk that others need to shed. In recent years, the rapid growth of these types of investors has been alarming to some, but almost surely has been beneficial for all investors, okay? So that's important to understand the perspective from the text and the CFA Institute. The second criticism and misuse of derivatives is destabilization and systemic risk. Speculators use large amount of leverage, thereby subjecting themselves and their creditors to substantial risk if markets do not move in their hoped-for direction. Defaults by speculators can then lead to defaults by their creditors' creditors, and so on. These effects can therefore be systemic and reflect an epidemic contagion whereby instability can spread throughout the markets and an economy, if not the entire world. So we saw a little bit back in 2008, the crisis, okay? Economic contagions, etc. Given that governments often end up bailing out some banks and insurance companies, society has expressed concern that the risk managed with derivatives must be controlled. So we'll just do a quick practice question here. Which of the following is not an advantage of derivative markets? A, they are less volatile than spot markets. B, they facilitate the allocation of risk in the market. C, they incur lower transaction costs than spot markets. Again, we're looking for the false here, so sometimes I read that. What is an advantage of the derivative markets? They facilitate the allocation of risk in the market. True. They incur lower transaction costs than spot markets. True. They are less volatile than spot markets. No, false. That's not the advantage. Derivatives markets are not by nature more or less volatile than spot markets. They facilitate risk allocation by making it easier and less costly to transfer risk, and their transaction costs are lower than those of the spot markets. So A was correct. They are not by nature more or less volatile than spot markets. Another quick practice question. Which of the following pieces of information is not conveyed by at least one type of derivative? A, the volatility of the underlying. B, the most widely used strategy of the underlying. Or C, the price at which uncertainty in the underlying can be eliminated. I don't think that question was too difficult. Which of the following pieces of information is not conveyed by at least one type of derivatives? The correct answer is B, the most widely used strategy of the underlying. Options do convey the volatility of the underlying in futures and forwards, and swaps convey the price at which uncertainty in the underlying can be eliminated. Okay? Derivatives do not convey any information about the use of the underlying in the strategies. And one last practice question to finish this LOS. Which of the following responds to the criticism that derivatives can be destabilizing to the underlying market? A, market crashes and panics have occurred since long before derivatives existed. B, derivatives are sufficiently regulated that they cannot destabilize the spot market. Or C, the transaction costs of derivatives are high enough to keep their use at a minimum level. Okay, that question is a good example of where I might not be sure. You know, I'm reading this and maybe I haven't covered it in the text, but transaction costs of derivatives are high? No, that's not true, so C is wrong. Derivatives are sufficiently regulated? No, they're over the counter, some of them. They're not sufficiently regulated. Boom, I know immediately B and C are wrong, so it has to be A. Market crashes and panics have occurred since long before derivatives existed. So derivatives regulation is not more and is arguably less than spot market regulation, and the transaction costs of derivatives are not a deterrent to the use. In fact, derivatives are widely used. So market crashes and panics have a very long history, much longer than that of derivatives. And that's the last slide for this LOS. Thank you.